In today's video, we're going to research selling naked puts on IWM the past 10 years, as well as look at how it did during the 2008 financial crisis. We're going to sell far out of the money naked puts as to make it a higher probability trade and use stop loss orders to minimize losses from market crashes. And all I ask in return for this video is for you to hit that like button to support independent research like this on this channel. Keep in mind that everything on this channel and in this video is for informational purposes, and this is not financial advice. All right, let's get started. All right, to set up this back test, we're going to select put. We're going to select short sell because we're going to be selling naked puts in IWM. But I want to put a couple parameters around there. And the first thing is we're going to put is a technical open. And basically what that means is we're going to choose to only open this trade if the stock is above the 200-day moving average. And that's going to keep us out of some extended bear market because we're going to look at the 2007 through 2009 timeframe where the financial crisis was. So we want to avoid opening such a high risk position. Even though we're going to look at a high probability, there is a lot of risk when the market turns down. The other thing we're going to do to try to manage our risk is we're going to add a 300% stop loss. And what that means is whatever the credit you received, if it increases by 300%, we're going to close the trade. Because remember, when you're selling a naked put and you get, let's say you get $5 for it, if that put increases to $1,000, you're losing money. So that's a 100% gain. So we're going to put a 300% stop because a lot of times the market can pull back and then it can recover. So we don't want to get stopped out too much. So we're going to go with a 300% stop for this particular study. And first thing we're going to look at is a 10-year look back. And let's go ahead and type in the ticker. And we're going to just look at a Delta 10, selling a Delta 10 naked put. A Delta 10 option is pretty far out of the money. And we can see over the past 10 years from the time of this video, it's had a 92% win rate. This is pretty much expected. 83 wins, 7 losses. And let's take a quick look at the chart of IWM that has the 200-day moving average on there. That's that blue line. You can see, had a pretty good run and then, dip lower, kind of moved up, and then it's been very choppy the last, couple years, and we're now kind of breaking out to new highs. So let's check out the P&L curve compared with the chart, and you can see that it kind of follows along the bull market kind of thesis here. So we have a really good bull run. Once the chart hits below that 200-day moving average, no more trades are open. That's what this flat line is. And then once the market kind of resumes its uptrend and back above the 200-day, the profits start to increase again. The problem we had from, let's call it 2018 through maybe 2019, was a big range bound market. So we made money, we got out, we did not open new trades. So this strategy really didn't make a lot of money the last couple years, but losses were relatively minimized. And then now that there's kind of a bull run again, we're starting to make money. Where that stopped, nobody knows, but it's kind of good to see what that looks like over the past several years. All right, so let's just apply the same study to the 2007-2009 financial crisis era, and let's see what that did. So we still had a pretty good win rate of 84% and made a little bit of money, but obviously not as near as much. Let's take a look at the chart of IWM during that time frame. You can see that for much of the period, IWM was below that 200-day moving average. So you can see this flat line here, and then it starts to make a little bit of money, and then the bottom dropped out in late 2008. And even though you had that 300% stop loss, that takes several trades to make that back up. So it flatlined for a long time, and then ultimately once we got back above the 200-day moving average, it started to make money again, but although it's still relatively choppy. So the 200-day moving average can keep you out of certain trades. However, had you been selling naked puts during this period, most likely you would have profited a little bit. So the 200-day filter, bull market filter, is a little bit of a gift and a curse, but that's what we're looking at for this particular study. So be sure to hit the like button, and if you want to see any variations of this study or maybe a different stock or a different study, be sure to put it in the comment section. I'll try to add it to the list, and we'll see you at the next video.